We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is David Haggith, author of the Great Recession blog and the Daily Doom Substack. How are you today, David?
Good, thank you. Nurturing a cold, but, nursing a cold, I should say, but otherwise good.
Excellent to have you. And of course, you've been writing about what you call the Great Recession. And as you said in one of your recent articles, that you've been a strident voice warning that where we are headed is predictable. So over the course of thinking about this, what calls stand out to you that you've either gotten right or gotten wrong over the years? And did you think that the system could continue this long in the way that it has without coming to a head?
I didn't really think it could continue this long. When I started my blog, the Great Recession blog, about 12 years ago, I called it the Great Recession blog and thought that this blog won't be going that long because things are going to collapse. And, so it's kind of outlived its name. So along the ways, I might have become a little bit over ambitious about thinking in terms of how long it's going to collapse or how soon it would be. About 4 years ago, I came up with this term I called the epocalypse, an economic apocalypse. And I was a little premature in predicting that. I thought it would be in a year or two at the time when I came up with the term, and we're still moving towards it. And I picked that term because I see it as being an epic event in size, an epic, EPOCH, as in it will be an epic of its own, a time of its own, like the Great Depression, that will, define itself. And we'll find a word for it, whether we call it the apocalypse, like I threw on it, or the Great Recession, the second Great Depression, or whatever. But I see it as being something that will be as bad as the Great Depression, though it will, of course, have its own characteristics. And I think we're moving into that now. And having said that, I was a little premature maybe in putting that label on it. I've been really dead on accurate. I guess if you're going to open yourself up to say where you screwed up on one thing and were too premature, then you got the right to say, on the other hand, where you've been accurate. And in the last 2 years, I've been extremely accurate, because rather than going for just the big picture of we're going to have this massive event that I think we're now heading into, I've parsed it down into the pieces that I thought would come. So when we started creating massive amounts of money in the Corona crisis and we shut down the economy, and people were all excited about the economy opening back up, I said, when the economy opens back up, because we just had this massive crash and stocks had gone down, the first thing I'd said is, prior to that, is next time stocks go down, the Fed won't be able to bail it out. And they couldn't. They threw everything at it and the stock market kept falling. And it didn't go back up until the federal government added all of its muscle to it and put its shoulder to the wheel and said, let's start pumping this money to the general masses. And then the masses started buying stocks, at a retail level. And then they finally got it to turn around, but the Fed by itself couldn't do it at that point. And I had said it won't be able to, because quantitative easing has basically reached the point where the law of diminishing returns is taking over, and they're not getting much bang for the buck anymore. And that's what we saw then. And so we had this big crash, and the government put its shoulder to the wheel, and we started pumping out all this money to the masses. And I said, okay, two things are going to happen here. Everybody was talking about how, the economy is going to be reopening in another month or two, and it's going to be great. And I said, yeah, well, everything's going to go back up. It'll go up with a boom. Why? Because when you shut the economy off with a circuit breaker, bam, and all the lights go out, then you've got this unique event where you can throw the circuit breaker the other way and bam, it's like a gymnasium when you hear those contactors go and boom, there all the lights are, right? And yeah, it'll come back on. But anytime you restart something like a big factory, you get a lot of breakdowns. And you don't know until you do the restart what broke down. And I said, that's what we're going to find out with this. We're going to have a lot of economic breakdown that's long-term damage. And it'll take us months and months to really see what the damage was from what we did here. So that was the first phase. And that's exactly what we saw happen. Jobs popped back up, but they didn't pop back up all the way, did they? They came back up and they were still, they've remained about 5 million workers short from what they were. Mm-hmm. The economy had a boom, but the economy has all kinds of supply chain problems because those broke. We'd already broken them in the trade wars. I mean, we caused damage. We were talking about it then before COVID hit. Now with these lockdowns, we broke them more, and we continued to do lockdowns, especially China, closing ports left and right, off and on, just constantly jarring things. So we busted that up worse. And I said, the next thing you're going to see after that, and I said this before there was any consumer inflation, I said, you're going to start seeing massive consumer inflation. Now, I had never said that in all the years I had written my blog. I've always been one of the people who sort of stood apart from the rest of those who look at this central bank and say, well, it's printing all this money, it's going to create massive inflation. And I've always said, no, it's not going to, because it's all staying in financial circles. It's all going into stocks, into bonds. It's just in this big cycle that's going round and round. And money only creates inflation where money moves. So if you don't have circulation into the general economy, it's not going to create inflation in the general economy. It's going to create asset inflation. And that's what happened. Mm-hmm. And we saw lots of that. But when the COVID situation hit and the government started pumping money to the masses, I said, now you're going to start to see some real serious inflation in the United States. And I said, the place to look is not right off the bat with consumer inflation. Let's take a look at producer inflation. So for that year, I focused intensely on producer inflation. I showed how production costs were going up, up, up. And, along the line, someplace along there, the Fed started getting just a little concerned that we started seeing consumer inflation. And so what did it say? It said, this is going to be transitory. And again, I took the opposite stance and I said, this is not going to be transitory. And I got laughed at by a lot of people, economists saying, well, you're an idiot. You don't know what you're talking about. And they would quote their theories as to why it's not going to happen. The yield curve hasn't inverted, et cetera. I said, the yield curve can't invert. The Fed is buying so many bonds at such an enormous rate that it has a lock on the yield curve. It's basically practicing yield curve control without stating that it is. Because you know that if you suck up 50% of any market or more, which it was doing, that you control that market. You're the whale in the pool, right? And that's what the Fed was being. I said, so the yield curve is frozen. It's not going to go anywhere until the Fed backs off of its bond purchases. And that, I said, is a key to understanding why the Fed does not understand this inflation, because it keeps looking at the yield curve and everybody else does and says bonds aren't pricing in inflation. It must not be going to be significant. It's going to be transitory. And I would say, well, it's not going to be transitory because, look, it's starting to go up in houses. We know that. If you're out buying in the housing market, it's up 10% at that time. And then eventually it was up 15 and 20. I said, that takes 6 months to a year before the things we see in housing prices show up in CPI, because there's that much lag there. Mm-hmm. So if we see housing prices, which are the biggest component of CPI, going up 10, 15, 20% now, then consumer price inflation is going to have a major hit down the road. So it's not going to be transitory, no matter what the Fed says and no matter what the yield curve says. But I couldn't get people to believe me. But it was clear to me it wasn't. Of course, eventually the Fed came around and said, oh, well, I guess transitory wasn't exactly a helpful term, and they admitted it wasn't. And I said, okay, now the Fed's starting to realize it's going to have to start tightening down on inflation. I said, so here's what you're going to see happen next. And this happened like clockwork. I said, you're going to see as the Fed starts to reduce its bond purchases, starts to taper off, the bonds start to rise, and they're going to start to rise as quickly as the Fed tapers off. And you're going to see the yield curve invert as quickly as the Fed tapers off, because what's happening is it's releasing that arm lock that it has on the yield curve. And now the yield curve is going to come along and it's going to price in a recession and it's going to price in the inflation. But guess what? It's arriving late to the party, because it would have showed you all of this 6 months ago, but it couldn't, because the Fed had this arm lock on it. When it can, it's going to be late in showing it to you. And all those people who are used, as economists, old school economists, to looking at that and saying, this is how we know there's no recession yet. This is how we know that inflation is transitory. They're going to be surprised when all of a sudden all this stuff goes crazy and the bonds start going crazy and the yield curve inverts. And of course, now we've seen the yield curve go nuts and invert, and it's late to the party. I said, you're going to find out we're in a recession at the start of this year. I said, it'll start with the first quarter being negative. Actually, I was a little premature. I said, we'll probably see it at the end of the fourth quarter, and we didn't. But the first quarter we did. And I said, then you're going to see the next quarter go negative, and you're going to see everybody deny it based on where the yield curve is and all, where the jobs market is, which is another thing we'll need to get into here. Mm-hmm. But I said, but you won't hear a recession declared, because you got to be in it for 6 months before they declare it. Well, now we've been in it 9 months and they still haven't declared it yet. So there's a lot of denial there to break through. But I think I was right on in saying that we were going to start the year in a recession. We've had 2 quarters of it. We're going to wind up with the third quarter of it reported. Each quarter I've said it's going to come in negative. Most of the voices out there said it wouldn't. It's going to bounce back up again. And it didn't. It came in negative. So, I'm convinced we'll have another negative quarter being reported here soon.
Mm-hmm. So, David, do you think that there, in some ways, is just so much going on at such an accelerated rate that it's possible that most just don't realize how precarious of a position we're actually in here? So, when we take into account the geopolitical risks and events, the markets, housing prices crashing, fertilizer and food shortages, and inflation raging out of control, it just seems like there's so much to take into consideration. Yet we all have this, recency bias telling us that things aren't actually changing this dramatically. So do you get a sense of this from those that you interact with?
I think that it's hard for people in general to get a sense of that. I mean, I get a sense of it talking with my own wife when I talk about food shortages and things are coming. It's really kind of hard. I said we need to lay away some groceries and things like that and be ready for this. It's kind of difficult for people to really believe those shortages are going to happen here in America, because they haven't. And so far, we haven't seen too much of that. We've seen a little bit. But what tends to happen in America is we have money. And so we can pay, and the same would be true in Canada, is we can pay more for what we need to have. And so what we see is price inflation. My wife walked into my study 2 days ago with a chicken in her hand and said, how much do you think I paid for this chicken? And I said, I don't know, it looks like about a $10 chicken, maybe $7, because they usually sell cheap. She had $15. She said, I've never seen anything like it. I said, well, I told you chicken prices were going up because we've been killing all these chickens left and right, millions and millions of them all year long. So I keep telling people, expect to see chicken prices go up, expect to see egg prices go up, because you can't keep killing off all those birds, creating shortages, and not not see prices go up. So maybe we don't see the shortages so much because we can throw money at it and get the product to come our way. So the shortages show up in other countries, we see high inflation. But eventually, I think we're going to see shortages here too. Mm-hmm. We've got supply chain problems, like I said, that we created with the trade wars, and then that we created with the COVID lockdowns. And now that we've exacerbated because of a war that's cut off supply routes through the Black Sea and elsewhere, and then that we've exacerbated more with sanctions that we pile on top of that. So yeah, we're going to see shortages. So I tell people, when you go out and buy groceries, whatever, buy twice as much of those things that have a shelf life that you normally buy. That way, it's things you'll use, and put half of it away and keep piling some in, because you don't know what's going to be short, but at least the things you normally use, you'll have a buffer stock of.
Mm-hmm. So, David, do you think that the rhetoric from the Fed, for example, contributes to this recency bias as well? You know, you recently wrote an article, or you start a recent article by giving the sailing analogy of Captain Powell and First Mate Yellen assuring the public that everything is okay despite all major stock indices and GDP going downward every quarter this year. So can they keep relying upon jobs reports as a positive despite many other negative indicators?
Yeah, the image I used there is our ship's already on the rock and listing sideways, and we can, hear the rocks grinding on the boards underneath. And Yellen's up in her crow's nest saying, I don't see a rock anywhere in sight, because she's looking out on the far horizon, but we're already on top of it. Mm-hmm. And so I think that Fed rhetoric hugely adds to that problem of people seeing it because they trust the Fed. The Fed has credentials. I don't have economic credentials. I just present how I see things, and I've been pretty accurate about that. But the Fed does, and they listen to the credentials, and the economists do, and they listen to the credentials. But the economists are just repeating what they hear the Fed say. Mm-hmm. And they're not questioning it. They're not challenging it, most of them. And so when the Fed says inflation's transitory, what do you read in almost every economist out there? Well, we believe inflation is transitory because yada, yada. And you hear them repeating the same things the Fed says as to why it's transitory. Well, it wasn't. They should be held to task for that. They're supposed to be smart people who are supposed to know this stuff. They're supposed to be the weathermen who say a storm's on the horizon. We've already been into the storm, and we're already on the rocks, and the weathermen are still looking out there saying, well, doesn't look too bad to me. No recession anywhere in sight, maybe in 2023. We're already in a recession. And so, you not only have the rhetoric that said inflation was transitory, but now you have the constant rhetoric of the Fed saying, well, we're not in a recession. And we know that because why? The jobs market is strong. Look at the jobs market. The jobs market is tight. So even though we see this really low GDP, well, we can't possibly be in a recession. There must be something wrong with that gauge. It must be telling us wrong information. Tap on the gauge. Why is it saying negative GDP? Because look at all these jobs. We've got this tight job market, so we know the economy's booming. Well, just as I had said that the yield curve being frozen because of the Fed was a broken gauge and was going to give us a late reading and was misguiding everyone, so the jobs situation is now the blind spot. I mean, that was the blind spot then, and that was the key to understanding why the Fed was wrong about rates or about inflation being transitory, when I was saying it was going to burn up their backsides and force them to tighten much sooner than they thought they would, and then to ramp up the speed of that. And what did we see? They started tightening sooner than anybody believed they would, and then they started ramping up the speed faster. Now everybody's screaming, whoa, you're going too fast. Mm-hmm. So the job situation is an even worse blind spot. These guys are sailing through a fog. And it's because they're old school thinking, and the recency bias that you talk about, and it's even beyond recency bias, it's long-term bias, has been jobs get tight because the economy is strong. And so there's a lot of demand, there's a lot of hiring, and the labor market just can't keep up with all the hiring that's necessary in order for production to keep increasing. Well, but hold it, stop. Production is not increasing. GDP went down the first quarter. GDP went down the second quarter. The Fed recently revised its GDP now graph down to almost zero. It's going to go down in this quarter we just finished. So if it's not that the jobs are tight because production's wrong, is the GDP measure really a failing gauge, or is it right and there's something wrong with jobs? And I say, hold it. Here's where we need to stop and take a look at what's really going on here. This is a whole different kind of job market. And the recency bias, or even long-term bias, is this is how jobs work. They're tight when the economy is strong, and people are not getting their head out of that. The jobs market is tight. And I've been saying it's because there are not enough laborers. And everybody says, well, that's because they're all doing so good they don't have to work. They're making lots of money off of investing in stocks and off of those stimulus checks. Well, the stimulus checks ran out a long time ago, so why didn't they go back to work? Mm-hmm. Well, because they made a lot of money in stocks. Well, the stock market's crashed and crashed and crashed all year. I don't think they had a lot of money left in stocks. So why didn't they go back to work? So I started digging into that question. And long ago, months ago, I was saying, what we have here is not a strong jobs market. What we have here is a seriously, seriously sick jobs market. We have a broken jobs market. We have a job market, a labor market, let's call it that cannot supply labor just to do minimum production. Production's going down, down, down. And the job market or the labor market can't supply labor even to keep up with that. So we still have these job shortages or this labor shortage because it can't keep up. Now, why can't it keep up? Well, the Brookings Institute just did a study, and I published this in an article recently about the job situation. And their study said that the jobs market is short 5 million people due to COVID. 1 million people in the normally participating labor pool died, attributed to COVID. Now, I'm just as happy with the idea that it's less COVID than it is the vaccine. I'm a person who refused the vaccine. So I'm not trying to get into a discussion about, is it COVID or is it the vaccine? The point is, there were 1 million excess deaths that have been contributed to COVID from within the labor pool. There's a whole lot more than that, but that's within the labor pool. Those people aren't going back to work. Now, 4 million say they have long COVID, whether it's due to COVID or the vaccines or some combination of both. I don't know, but there are 4 million people who have said, I'm not going back to work because COVID or whatever has knocked me down so bad that I'm incapable of work. And they've been in that status for a year or more. They're not going back to work and they're not getting better. Mm-hmm. So far, there's no evidence that they're getting better. So that's 5 million people knocked out of the job force, possibly permanently. And that's why the job market is tight. It's not because production is up, the economy is booming, and labor is struggling to keep up. It's because the labor isn't there. Now, what does that tell you about a recession and GDP? If you can't supply the workers to do the production, production isn't going up. It can't go up. You don't have the labor force to do it. That's what they, companies are really saying is we can't hire laborers. We'd like to do more production. We need to do more. People still want to consume, but we can't. So production is held down by the lack of labor. And that sends prices up because if you got money that the Federal Reserve is creating and it's now in general circulation, the formula for inflation is you have a combination of too much money and too few goods. It's when you have both that you get general price increases. There's a shortage. I mean, people don't bid up the price of goods just because they have a lot of money. You can become a millionaire or a billionaire, and you don't go out and say, I think I'll pay $5 for an apple. You're going to look at the two apple guys selling it. If one guy's $5 and the other guy's $1.25, you're buying the $1.25 apple, no matter how rich you are. But when this guy that's selling them for $1.25 goes out of business because he couldn't do it at that, and the only guy that's left is $5, and you got money, you're paying $5 to get an apple because you want one. And so the shortages will cause you to use the money you have to spend up prices. And that's what we're seeing now. And without labor, we can't get that production up. But these people that are all sick, they're still consumers. So they're still demanding goods. They still want to eat. They still want to wear clothes, et cetera. So there's still a demand for goods, but there's not the ability to produce them.
Mm-hmm. Yeah, I think it's interesting to break those job numbers apart a little bit. When we think about, let's say, new job numbers that the Fed seems to rely upon, yet we look at the actual labor market participation rate, and that has gone down, yet new jobs keep going up, which is seemingly like people are getting second and third jobs, yet overall there are less people that have the ability to work, to your point.
Exactly. Just this morning, and I haven't even had time myself yet to look at this yet. I just saw the headline and put it aside, said I'm going to look and see what it is. But the headline was that the jobs report, the JOLTS report for the latest number of jobs was abysmal, that it just tanked. But that's new, right? That's not what we've seen. I think what we've seen happening is, there were jobs being offered out there but we don't know when a job's offered and when it's added to payroll, either one, whether it's an old job that's just recirculating, because a lot of jobs are posted for 30 days and then they automatically fall off. They're designed to. And then the company reevaluates and they say, yeah, we didn't fill this position. We still need to. And they relist the job. So a lot of those jobs are the same jobs listed over and over again. And we think, oh, jobs keep coming. It must be going good. No, maybe the same jobs. And when you look at payrolls report, you say, well, look, more payrolls. Well, payrolls don't distinguish between who has one job and who has two and who has three. They just look at each person hired as a unique person hired. And we're now in a situation where in the United States, we have more people running 2 and even 3 jobs than we've ever had by quite a substantial number. I can't come up, on the top of my head what the number is, but I read it recently. It's significantly higher, the number of people who are now running 2 or 3 jobs to make ends meet because of inflation. And they're able to get those jobs because there's this shortage of labor, So they're stepping into another position and taking it. So that whole market is so distorted that if you're using that to say, well, we're not having a recession because it's, labor is tight, so we can't be. No, labor is tight because the labor market is badly broken. It's literally sick and dying. And as a result, you can't use that as a gauge for whether or not we're in a recession. Mm-hmm. It, in fact, is going to be the cause of a recession, because if you can't produce, then you're in a recession.
So, David, let's maybe take a step back and look at more of the, let's say, the macro picture around the world. What is weighing most heavily on your mind at this current time? Is it the pipeline attacks that we saw last week, the saber rattling coming out of the East and the West, or foreign currencies like the British pound and yen falling apart and all the downstream consequences that could cause?
It's all of that. And that's why I say I think we're finally entering into that period that I called the apocalypse, which is the breakdown of the everything bubble. It's everything falling apart at once and cascading into each other. The pipeline situation, well, those pipes were set to go off production. Maybe it's not a big deal because Europe was weaning itself off. And in a few months, they plan to go off of it completely anyway. But maybe it is a big deal because it's cut off as an emergency backup they might have been able to use. I doubt it, because of sanctions, et cetera. However, it's a scare because what happens if the same thing happens to the new pipelines that just went online? There's 2 of them that just went online. One via Turkey, I think,
coincidentally,
the Baltics. And what if that happens to them? Well, God forbid, because then it's going to be real serious. So it's a scare, just the fact that it could happen, who's doing it, and, that could be really scary. Because those pipelines are kind of the saving grace here. So that's a concern. And all the shortages, we're just going to start to see those in the winter, right? Because they happened during the summer with crops that didn't get planted in Ukraine, crops that didn't get shipped out of Russia or Ukraine, fertilizer shortages that have resulted in crops being down all over the world due to fertilizer, and then droughts in the U.S. that added to that. U.S. corn production is down something like 20% on average across the whole country. But all of that doesn't hit right now because we've been finishing up the last of last year's corn stocks, leading up to the harvest to get the elevators, grain silos clear so you can put the new harvest in. But where we're going to start seeing it then is as, we start running out of the new harvest late next winter or into next spring, there'll be enough in the silos to take us that far, but there won't be enough perhaps to take us into the early summer months when usually we would, where we're still living off of the previous summer's harvest, right? Until the new harvest comes in. So we're going to see a tightening up of prices in advance of that because, prices anticipate what's coming, and when the harvest is all in and they look and say, well, the silos are only 80% the capacity they usually are, then prices are going to go up. So we're going to see that. So I'm concerned about where those shortages are going to show up. And I just say to people, lay in a buffer for yourself. Because if you're just buying the stuff you're going to use anyway, and it has a good shelf life and you rotate it, you're not storing up stuff that's going to cost you anything. You're going to have to buy it. and down the road you probably have to buy it at a higher price. So worst case situation, you saved yourself some money because the prices are going to be higher down the road if you got the cash flow to do that. I wouldn't go out and do it on credit because that's a dangerous thing once you start buying your food on credit. But do what you can. I think that we just saw how fast things can go totally out of control with the Bank of England and bonds and pension funds. Pensions are supposed to be the most boring funds in the world. These are the world's most conservative investors normally, because their job is to make sure this wealth you've set aside is preserved so you'll have it in the future. So they try to invest conservatively. And we were just told that within 24 hours, pension funds could be going broke all over England. And so the Bank of England had to rush in with what's now turned into $100 billion in quantitative easing like that. They originally said something like 70 billion, and they just upped it today, I think, or yesterday, to 100 billion, as the problem was bigger than they thought. And you say, okay, this just came up out of nowhere. We didn't hear anything about it a week ago. And all of a sudden, the Bank of England was talking about tightening. They never even got to tightening before they said, whoa, we got to go right back to full-on quantitative easing. And so they're back, and to save pension funds from busting. And we don't know what damage there is in those funds and, who's going to wind up coming up short. We know that there are funds now that are already limiting, property funds and things that are limiting, in the news I saw today, how much people can withdraw from those funds to keep the funds from breaking. So I don't know what the damage is going to be there. Maybe the Bank of England has it under control. Maybe we're going to find some major retirement accounts went bust that they just, haven't announced yet where they're at. Because they'll hide these things as long as they can. Lehman obviously knew, and Bear Stearns knew well before the rest of us did that they were in serious trouble. But you don't let the public know those things. And so, I don't know what's coming up. But when you see those kinds of emergency situations where central banks are suddenly rushing in and nobody even knew there was a problem, then your Lehman moment is near. And if it can happen that fast there, it can happen that fast here or Canada or wherever. So I think we're going to start seeing those kinds of things. And when they happen, we know from the last time that sort of thing happened, in the Great Recession, where I named my blog, is that it becomes a cascade and one thing falls into another, and one bank's collapse becomes another's collapse. And this can quickly, just be dominoes going over. So I think we're in that kind of precarious position, and the Fed just stepped up to tightening faster than it ever has in the history of the world. No central bank has ever tightened faster than what they just leaped up to in September. So here we go. Now it's October. We're on full speed tightening. How far is the Fed going to get down that road before it starts creating catastrophes? Now, we saw this insanity in the market where investors were saying, well, there's going to be a Fed pivot, because they can't go any farther with this. And so prices went up, and now they're doing the same thing all over again. And it's so stupid. It's just unbelievable to me. And we talk about recency bias. Oh, the Fed always pivots. That's the recent situation. The Fed always, backs off as soon as the market's going down. It's not going to be able to back off and pivot in the middle of scorching inflation. That's one of the other things where I ran against the direction everybody was saying, and I was right on that. I was saying, throughout the whole time we were hearing Fed pivot, I was saying, no pivot. It's not going to happen. This time is different. In 2018, they could pivot, and I said they would, because I knew their quantitative easing or quantitative tightening was going to be a bust, that they couldn't possibly do it. Because if you push something up with all this massive money, then when you drain the money out, it's going back down. That should be self-evident. And it's just stunning to me that people don't get that. But they can pivot then, because they didn't have any inflation. It was virtually zero. They couldn't even get inflation at that point up to 2% where they wanted it. So they had all the liberty in the world when markets started blowing up as they did in 2018. And, that was an area where I predicted exactly what would happen. And it did. I said that the market will go bad in January. And in that January, it had a real big plunge at the end of January and through February. I said it'll have more big problems in the summer when the quantitative tightening gets faster. And it did. That's when all of the FANG stocks broke, went into like 40% bear markets of their own. But I said, but the big problem is not going to happen till the fall. And then the whole stock market is going to tank. And it did until the Fed pivoted, or announced that it was going to and said, okay, we're going to stop this stuff. And they finally put an arrest to the fall. But this time is different. This time the Fed has scorching inflation. It can't just leap back to quantitative easing without throwing gasoline on that fire. So it's going to go until something breaks. And then people are like, well, hey, we're close to something breaking. So yay, the Fed's going to pivot. Let's buy more stocks. I'm like, no, you don't get it. When something breaks, we're talking Lehman. We're talking Bear Stearns. Only this time, the Fed isn't just starting with quantitative easing. It's already got a balance sheet that's way up here. It's not going to work like it did last time when they jumped back in. So there's no reason to be thinking, oh, okay, something breaks and the Fed will change. When something breaks, the break is going to be seriously bad, seriously cascade into all kinds of problems, because this time we have the everything bubble. It's not just housing prices. It's, housing prices, it's bond prices, it's stock prices. And as bonds blow up, that's going to be way bigger than when stocks blow up. Mm-hmm. Because bonds fall to a certain point and all of a sudden they start getting re-rated and the whole financial system tightens up real fast. And then companies that were dependent on that bond financing start going out of business and their stock. I mean, it's just, that's by far a bigger bubble that has a lot more potential to be catastrophic and to take banks down than stocks do.
The bond bubble being what you're talking about being a lot more catastrophic for all of the markets.
Yeah, already we've seen the biggest, let's just go ahead and call it a bond bust, because we've seen the biggest bond decline, I think, in history, at least going back to the Great Depression. Times I'm not sure exactly, but we've seen this huge decline of over 15% in a lot of bond funds that have crashed in value. And there's no evidence that that's going to stop if the Fed keeps tightening and keeps driving up interest rates. So until the Fed breaks something bad enough, and that something may be the bond market, things are going to tighten until the bond market does break. But when it breaks, that can be catastrophic. That can put, banks out of business. That can put pension funds out of business. That can put hedge funds out of business. It can create all kinds of problems.
So, David, when you're talking about this Lehman moment, and we take something specific like the Credit Suisse credit default swaps soaring over the last couple of days, is it
right,
the rate at which they're going up or the nominal value that they're now, let's say, going for that's the issue, or is it just the fact that they are accelerating that is the risk qualifier or risk pointing red light that is the signal that shows us?
Yeah, the bond market is really complicated and it's not my area of expertise as much, but my biggest concern is the acceleration. And certainly Credit Suisse provides a glaring example there. Right. One of the things we've seen in the bond market is normal differences in credit swap rates, and things are like way getting out of sync from where they're supposed to be. And these are supposed to be boring metrics. So when you see them suddenly moving quickly, it's that acceleration that makes me concerned that we could have a serious problem here. That's why we saw the Bank of England jump in with the problem. It's why we see Credit Suisse suddenly, flashing alarm signs. And, Deutsche Bank is not much better off. These are old time banks that have been around forever. I mean, they're, the foundational banks of the world. And they're in serious problems. And we don't know just how serious exactly, because we know they tend to hide the worst news. But we know it's bad and we know it's been getting worse quickly. So at which point does one of them just go broke, need another big bailout because they're too big to fail? And there we go all over again. Mm-hmm.
So you were saying that the Fed pivoting, or it can't pivot this time, or that this time is much different. Is it just that they're not going to be able to have the effectiveness to save the markets in which they have in the past? Or is it that you don't think they're going to pivot, period? Because, they have a real kind of dichotomy here where they're in some ways causing the rest of the world to crash, and they're receiving pressure from the rest of the world to stop hiking at such a fast rate. And yet on the other side, they're trying to combat this inflation and really this supply side inflation by crushing demand. So, it really puts them in a very interesting and difficult spot. So do you think that they will not pivot because of inflation, or that they just won't be effective in the outcome that they want by pivoting?
I think they'll slam on the brakes hard right after they've hit the tree. And, so it becomes a point, and they can shove it in reverse, but the car's broken, so it's not going anywhere. And I think that's where we're going to end up. Is at some point, they're going to try to pivot, but they've totally smashed things up to where it's going to be highly questionable that they can do anything, because in order for the Fed to accomplish anything when it does something, its number one stock in trade is credibility. Its money only has value so long as it has credibility. That's what it's selling, is trust and its ability to manage this money and to give value out of nothing. Because, we all know that fiat money doesn't have intrinsic value. It has a managed kind of value, and that works so long as you trust the managers. And it doesn't work if you don't. So this next crack up is going to be severe enough, and is clearly going to be on the Fed's head, that they're going to lose a lot of credibility, and that's going to diminish the power of their quantitative easing when they do try to jump back into that. And I'm sure they will at some point. But with things already busted up all around them, it's not going to have a lot of credibility. Remember, 2020, like I said, I was saying then, their quantitative easing isn't going to be effective in turning the market around, and it wasn't. They dumped in more quantitative easing than they ever had, and the market was still falling. It only turned around when the federal government, for the first time, jumped in with its own shoulders and said, let's push this money out to the public. So that, they're going to probably have to do something like that again. But then you got to ask the question of, well, when everything's broken, how effective is that going to be? Is it going to rebuild the economy? Is it going to recreate people that can work that died and that are sick? Is it going to solve that problem? No, the Fed can't solve that problem. Is it going to repair the shortages that we've created with trade wars and COVID lockdowns and a real war and sanctions? Can't solve that problem. So you got all this wreckage that human beings have been piling upon themselves for various reasons for several years now. The Fed can't solve any of that problem. The federal government really can't solve those problems. And if they did, it would take years to unpile it and straighten it all back out again. So it's not going to get the economy going. So the only thing I can see it doing is at that point driving hyperinflation, because you're still going to have all the shortages for all those reasons I just listed, and you're going to be dumping money into it, and you're going to have the federal government saying, we got to do what we did last time and distribute to the masses, but it's not going to help production at all, because those things are still broken. So, unless you can use money to create, 5 million workers to replace the ones that are dead and sick, it's not going to help. So the only place I can see that money going is just to people bidding up the price of limited goods and limited services due to all those shortages, including the shortage in labor. So you're going to see the prices go astronomical. So then you get into a hyperinflation cycle, because they're taking the solution of, recency bias. Let's throw money at it. That's what's worked in the past. That's what worked in 2008. But now you're throwing money at something that's so broken, you can't fix it with money. You could fix that problem sort of on the surface with money back in 2008. But, like I just said, you can't fix all the problems we're creating for ourselves now with money. You just can't. So you throw money at it, all you're going to do is bid up the price for those things that are available by giving people money they can use to do that. You're just devaluing your money. You're not solving any problem.
Yeah.
So that's the serious crisis I see us going into.
The Fed can't print more commodities. It can't print more energy. It can't print more fertilizer or food. All we can do is, like you say, is force up the price of those goods that are available by printing more.
Yeah.
Exactly. So, David, if we're heading for, let's say, a a greater recession or depression, however you want to put this, what holds up in a situation like this? You know, gold is down on the year, but it seems nearly everything else is too. So where do we go?
Well, gold is tough because there's a reason central banks own it. And this is something that I've always said, is that they own it so they can crash it. They don't love gold. They use it as ballast. It's practically, I look at it as being practically free to them. If you own the money printer that you use to buy the gold and you want to buy more gold, print more money. I mean, there's ways to do that and move the money through and get gold back into your central bank. And why do you buy it? So that banks can manipulate the value of it. So if their currency starts to go down, I mean, this is my view, they can throw it off like ballast because it's their natural competitor. It's the one thing that's seen as having intrinsic value, right? So they own it so they can throw it off and try to damage the gold market. I think we saw that happen back in 2020 where people were wanting gold. You couldn't buy gold. The markets were tied up. And, you couldn't sell your gold. At least it was harder. So gold is problematic because the central banks try to make sure that it is. Now, I'm not saying don't buy gold, but I'm just saying recognize it's got its problems. It's certainly been stronger than stocks. It's been better than bonds. But so far, the approach I've said for people to take is stay in cash because cash loses less than gold right now. I mean, with gold, you got a 10% decline maybe, or 8%, whatever it is right now in the value of gold versus if you bought it at the start of the year. But then let's say you bought it at the start of the year and you sell it now and you lose the 8% or whatever it's dropped. And, correct me if I'm wrong on that number because I haven't tracked it recently. You lose that 8%, you sell it, you got dollars back, but the dollars you get back are still worth 10% less than they were a year ago too. So you still lose on the inflation side. The dollars you get back are, have dropped in value and you lose what you lost on the gold. So you're not really better off than if you just had the money parked in cash. Now, at some point when banks start crashing, cash is going to become hugely problematic too. And, what do you put your money into then? And I haven't really figured that out yet. For now, cash is still relatively safe, but we're not out too far off from when banks can crash. And then cash might not be safe, or if the Federal Reserve goes into its hyperdrive of QE, well, then cash is going to really see bad inflation. And how that will compare to gold and other things at that point, I don't know. Some people think, well, then, gold will go up in value comparatively, and maybe it will. Mm-hmm. But just count on banks to try to make sure it doesn't.
Mm-hmm. Yeah, and I think it just depends on, let's say, the incentive of which bank, let's say, tries to revalue gold or how, there's a million different ways that any of these processes can play out. And I appreciate your view saying that, we don't necessarily know exactly how that's going to play out or what is going to be the best asset to have at that time, right?
Yeah, I think we're going to have to be nimble on our feet here. And, I'm going to try to keep my eye on that and see what plays I think might make sense as you see how things are falling apart. But really, until you start to see how things are falling apart, it's hard to know what lily pad to jump to next, because that's the situation we're on, is wherever you're parking your money, it's all at risk. Mm-hmm. It's all blowing up. It's everything bubble. So bonds aren't safe. Stocks aren't safe. Gold is manipulated. We just saw that with the whole JPM case, right? That's no surprise. And gold has been going down. And pretty soon cash isn't going to be safe either, because central banks are going to be printing tons of it to try to solve a problem that this time can't be solved with money. So, what do you jump on next? You couldn't jump on land. That wasn't safe because it's going down in value. So if you're looking at jumping on it for storing value, well, it's going to lose value. If you look at it for intrinsic value, if I need a place to live, I want to grow some stuff, well, yeah, okay, then it's got value. And down the road, it always recovers its value. So you can do that as a long-term store, but it's not going to help you weather through the present crisis, other than if you're good at growing things and you have the strong back to do it, you can protect yourself that way. probably most people who are going to make that kind of choice have already made it. So we're just going to have to be nimble and try to look for, which lily pad looks the safest to jump on, and hope it floats when we land on it.
Mm-hmm. Absolutely. Well, David, I think that's a logical place to kind of end our conversation today. Is there anything else that you can think of that you'd like to leave our audience with?
No, I like that as a good landing place. Be nimble, be aware. Whatever you jump on, it might not hold you up. Mm-hmm. But we'll just keep looking and try to be nimble.
Mm-hmm. Of course, your website is thegreatrecession.info. You publish a lot of different articles there from yourself and some guest publishers there. Your Substack, The Daily Doom, as well, and on Twitter at Economic Recess as well, right?
Yeah, thanks.
Perfect. Thanks so much for your time today, David. I really appreciate it.
Enjoyed the conversation.
Me too.
All right. Bye,
Stay
Tom.
well.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.